Welcome back to Money Life, where it's time for the big interview. And I am joined right now by Fritz Folts. He is the Chief Investment Strategist at 3EDGE Asset Management. If you want to learn more about him and the firm, it is 3EDGE, the number 3, 3edgeam.com. Fritz Folts, thanks for coming back to Money Life.
Chuck, always a pleasure to be with you.
I want to dispense with current events first here, but not the current events that are going to take some time. At least by my expectation. I'm talking about the current events that are hey, we keep having little surprises here. Things like Evergrande and whatever to shake the market up, and some stuff that has made it that the last couple of weeks have been a little frothier and a little more uncertain. But they're not the bigger, longer lasting current events like inflation, where the talk has kind of become a little boring because we've been talking about it for weeks. Mm-hmm. So any of this short-term stuff, does any of it actually matter to you as an investment strategist in this market with the big underlying boring stuff like recovery?
Right.
Do you look at Evergrande or something like that and go, yeah, I got to, debt ceiling talk, whatever it might be, and go, yeah, maybe we got to change what we're doing now?
Right. So definitely not necessarily change what we're doing. The Evergrande situation, it's going to work it out. I mean, they're going to restructure that debt, but it could, the way I would describe it is it could add to, if you are concerned about a global economic slowdown and you have this event take place in China, well, that could make the slowdown perhaps more pronounced. And perhaps maybe that could make institutions who, banks or lenders be a little more stringent in the way they look at lending. So, it's sort of at the margin, it might increase or decrease, but no, by itself, it's not going to rock the market. I mean, to me, the big news was last Wednesday at the FOMC. If you want to talk about that, I think that has really changed the playing field at this point.
Explain how.
Right. So for a long time, the Fed has had it really pretty easy since the onset of the pandemic, right? And I think their job now is going to become much more difficult. When the onset of the pandemic, the Fed was able to maintain its extraordinary monetary policy and pointing to the fact that they needed to see substantial further progress on the economy and labor market before beginning to dial back their easy monetary policy. And they could lean on this and, just continue to keep monetary policy easy and keep interest rates low. And they just, did that. But now I think we've arrived at the point, on Wednesday of last week, they were explicit about the fact that they were probably going to announce in November that they're going to begin to taper. Okay, fine. They would like you to believe they're just sopping up excess liquidity. It's not a big deal. But we also see now the dot plot is indicating, that they may need to raise short-term rates as soon as 2022. And to their credit, they've done a good job separating out those two events, right? The tapering is not increasing interest rates, and so they've done a good job at that. But I think the problem they're going to run into potentially is inflation is potentially becoming more and more of a problem. At the same time that I think we might be seeing an increased risk in the global economy slowing. And so if you get inflation expectations rising and you get the global economy starting to slow, well, that puts the Fed in a much tougher position, between the rock and the hard place. And I think that's what could be problematic going forward. Obviously, we're seeing rates rise, right? Interest rates have spiked up, and that can happen for two reasons, right? So, you could have rising interest rates, a steepening yield curve, and that's an indication of strong economic growth, and it's all good. Or, of course, you could have rising rates because you are having persistent inflation and rising inflation expectations. And I have a feeling it's more the latter at this point that is driving rates up. So I just think that the Fed's job is going to become much, much more difficult going forward from here.
If we're now going to have higher for longer on inflation, how high and for how long? I mean, there is a delicate point on inflation that says if you're at this level, we're probably okay and things can probably go forward and we'll see some growth and we'll be able to weather this. But if you go just beyond it, you get to that tipping point, you could see some bad stuff. So which side of that are we on and how high is inflation for how long?
Well, that's a great question, and it gets to the question of, well, what's normal? You know, when you've been at this low for this long, and someone says, well, rates have to go back to normal and inflation has to go back, you know, maybe that's a different number now than it was a few years ago. And I don't know. And my guess, if I had to guess, which I will, is we're not going to get hyperinflation. There's just too many structural things in place that will keep it without getting completely out of hand. But, you know, these supply chain issues aren't going away. These shipping disruptions are here. This Delta variant is really ravaging Asia. You know, places like Vietnam where they, you know, manufacture so much clothing. And these issues I don't think are going to get solved for a time. So I do think inflation is going to be higher. It's going to be a problem into 2022. But it's not going to be hyperinflation. We're not going to need Paul Volcker to ride in and raise interest rates.
How do you then respond to this kind of an environment as an investment strategist? Because we know that everybody's looking for yield. They're not getting it in their bonds. Their bonds have become less attractive because inflation has gone up. Even if you're trying to get your yield from dividend paying stocks, you're paying more to get them.
Oh, yeah.
So what is the right approach at this point? I was talking to somebody recently who said, you know, 5 is the new 8 when it comes to yield.
Yeah.
It's a great line, but I'm not sure that most investors are willing to settle for that.
Right. So it's difficult. I mean, it's difficult. If you look, you know, we spend a lot of time, we look at valuations, and granted, that's a long-term measure, and it doesn't really matter over, you know, weeks or months. But it's very difficult to try to bang out some level of attractive returns without taking an inordinate amount of risk. So on the equity side, we're not at our minimum in equities, and that's some of the reason is you can't really afford to be the way the equity markets have been going up. But we're closer to our minimums in the U.S., where we see significant overvaluation, and we have moved some of that equity position to ex-U.S. equities, including Japan, because there are much better valuations there. We like India equities, you know, but so you have to really be a little bit creative about how you cobble this together. We had also were treated very well by commodities, and they sort of, you know, people felt like, okay, so that, you know, that first burst of growth in the commodity sector is over. But with energy and the oil price doing what they're doing now, you know, commodities could still do okay, and maybe you could carve out some return in the short term there as well. So, I mean, we're multi-asset investors, so we look across all the different asset classes, and that's what you have to do in here because it's difficult to generate the, you know, the returns, and you're not going to get it from, you know, your yields on those bonds that most people are, you know, used to get, and it's very frustrating. And so that's why you see credit spreads, you know, so incredibly narrow, and people willing to take so much credit risk and duration risk because they're so desperate for yield. But that could end up very, very badly.
Well, I was going to say, not only could that end up badly, but it's the kind of thing where, I mean, that's a leaky roof strategy. Your leaky roof is fine until there's a storm when, oh, by the way, it's a problem. How disappointed are people going to be? I mean, you deal with clients. How do you set expectations? Because on the one hand, they don't want the bad news of your returns aren't going to be as good. And on the other hand, they're going to fire you, whether it's your fault or not, even if you warned them, if there's a big surprise down the line.
Right. So we always focus on risk management. For us is foundational to what we do. And we say to our clients that where we really shine is when the market turns down. We are very good at preserving capital in those dramatic downturns that can be so injurious to an investor's portfolio. But we do have to manage expectations, and clients will call you and say, gee, you know, how come you're not keeping up with the S&P 500, which is up, you know, high teens this year? And that's when we have to remind people and say, you know what, if we were keeping up with that, we wouldn't be doing our job because we wouldn't be paying attention to the risk side. But it's a constant educational process, and it's a constant communication to your clients, that is not what our portfolios are not meant for that. Our portfolios are meant to provide greater diversification and to generate an attractive return, but with least amount of risk possible. So they almost diversify an investor's overall assets.
You talked a little bit about where you are going and how you're looking to be more internationally diverse, et cetera. Mm-hmm. But in terms of market themes here, mm-hmm. where are you in this cycle of recovery with recovery plays versus longer term technology with what we're seeing? Because it's very clear or becoming clear every day that although we're going to get to recovery and we're going to reach it at some point in the next year and a half, 2 years, the post-COVID economy and the post-COVID market is not going to be the same. Oh, the numbers may say we're back to where we were, mm-hmm. but the business community was forever changed. Certain industries will be done forever. You know, whatever acceleration we've seen in various trends is not exactly reversing course. So where are you trying to focus your attention in terms of what you're buying and what you're moving away from?
Right. So again, you know, we have moved away from U.S. equity market because of the valuation and because it's just like, I saw someone recently said that if you look at the S&P 500 over the last 90 days, 50% of the performance of the S&P was from 4 companies: Google, Apple, Tesla, and now I can't remember the fourth. But I mean, that's incredible. Microsoft, Apple, Google, and Tesla. 50% of the performance of the S&P during the last 3 months. So we are at our minimums or near our minimums in U.S. equities. We like Japanese equities. We like India equities. We had like Europe, but we've dialed that back as well. We have some minimum amount of treasuries because, you know, for all the talk of rising interest rates, there are plenty of people on Wall Street who will say, hey, listen, the 10-year is going to hit 1% before it hits 2%, right? That if you have this global slowdown, interest rates are going to tick up, but we're just going to have these central banks are going to have to come back in and stimulate again. So we own some treasuries, a minimum amount. We stay away from credit because spreads are just so ridiculously narrow. And we like gold, which has struggled a bit, but it has, you know, over the long term, it's a very good shock absorber for us. So if there's a problem, geopolitics, et cetera, which are sort of heating up here, and if the central banks do have to revert back to more easy monetary policy, gold holds up well because it's an alternative currency. So it's really a diversified approach, and it's very difficult to point to one area and say, oh, we love, you know, we're really committed to that asset class, or we're really committed to that geography. It's much more of a patchwork quilt of piecing together different asset classes, different geographies to try to generate a return, but without taking too much risk, which we feel many investors at this point are. You know, they're just people are way too speculative, and I feel like that's going to cause problems for them down the road.
Well, speaking of speculative, you talked about gold, classic assets. You talked about diversification. Mm-hmm. What about crypto? Because some people consider crypto to be its own really interesting asset class. Some people say, well, it's blockchain, and I'd rather just consider it as part of technology or a subset within technology. Mm-hmm. And some people, including many of the regulators, go, I can't even figure out if crypto is an asset.
Right.
So where are you on Bitcoin and the other cryptocurrencies?
Right. So we've looked for a long time at digital currencies and at cryptocurrencies, and we've gotten, as you know, every other investment management firm in the world has a lot of incoming from our clients who are interested. And, you know, it runs the gamut. You have some people who think, you know, this is, you know, I really want to put my money in here. I think it's for real. And then others at the other end say, you know, I don't understand this at all. I'm going to completely stay away from it. So we actually earlier this year launched a crypto strategy for our clients wherein we use our model to model the digital currency market. And, you know, it's more of a stock to flow type model. And the objective is simply to use the model to get out of the way of those downturns, because the downturns in crypto are so extreme. You know, it can be 80% down. So all we're trying to do is just avoid that. But we would say this is for only a very, very small portion of your investable assets. So we think that we're in the adoption phase, that, clearly institutions are interested. They're starting to participate. And so we think that it is for real enough because now there's so much institutional participation in it. And the other way that we look at this is as digital gold, which I think is sort of what you're getting at maybe. People look at gold and they say, okay, it's almost the opposite of paper money. You can't print it and you can't make more of it. And so it just takes more and more paper money to buy your ounce of gold, or you can look at that and say, well, the price of gold has gone up. We have definitely seen people who might have done that, and maybe it's younger people, might have put money in gold as a currency that the central banks are not able to get at, except in China, of course. But so we think that is definitely going to happen, that it's an alternative form of gold. You can look at it as digital gold. So in some respects, to help our clients who have been very interested in this, we have started a strategy, but we really stress you have to understand that the declines in the crypto market can be 80% drawdowns. And, it's easy for people to say, oh, I don't care because I know it's going up until that happens. Right? It's always
a lot easier till it's actually your money on the line.
Exactly right. So, yeah, we think that it has a good chance of, but, it's going to be rocky. It's going to be tumultuous. Central banks are going to want to get into this game. And what does that mean? And, China just ruled it to be illegal. So it's going to be adventuresome, but we are participating to try to help our clients navigate the space.
Fritz, great stuff. Thanks as always for joining me.
Chuck, I'm always glad to speak to you. Thank you very much. Always very interesting to speak with you.
That's Fritz Folts, everybody, Chief Investment Strategist at 3EDGE Asset Management, 3edgeam.com, on Twitter at 3edgeam.